No matter whether you're trading stocks, crypto, or any other financial market, a power tool that helps you capture trends and find entry and exit points. Hey everyone, welcome to my technical indicator learning channel. Today we're going to master a super practical indicator in just 10 minutes, the EMEGA. A lot of beginners get stuck on the difference between MA and EMA, thinking the more complex an indicator is, the better. But in reality, simple as precise is the real key. Today we'll break EMA down from 3 angles: what it is, how it's calculated, and how to use it, so you can start using it right after watching.
Don't forget to like and save this so you won't lose it later.
First, let's get this straight. What exactly is the difference between EMA and the MA we're familiar with? First, let's quickly review the basics. When people talk about moving averages, MA, they're usually referring to SMA, the simple moving average. For example, a 60-day moving average is just the sum of the last 60 days' closing prices divided by 60. Plot 1 point per day and connect them. That's your SMA line. Pretty simple, right? But EMA is different. EMA stands for exponential moving average, and the key difference is this. SMA treats every day's price equally, while EMA gives more weight to recent prices. Here's an analogy. SMA is like a teacher calculating the average score of the whole class, where every student's score has the same weight. EMA, on the other hand, is like a teacher placing more importance on the most recent exam because it better reflects the current level. That's why, under the same parameters, EMA stays closer to price action and gives more timely signals than SMA.
So how is EMA calculated? Don't worry. The simplified version is super easy to understand. A lot of people get a headache when they hear words like exponential or formula, but the logic behind EMA is actually very simple. You don't need to memorize it, just understand the core idea. Step 1, choose a parameter n such as 9, 17, or 21. These are the most commonly used. Step 2, for the first EMA value, just use the SMA of the previous n days as a starting base. Step 3, for each following day, calculate EMA using this formula. EMA today equals today's closing price minus yesterday's EMA times 2 over n plus 1 plus yesterday's EMA. For example, if n equals 9, then 2 over open parenthesis 9 plus 1 close parenthesis equals 0.2. That means today's price carries a 20% weight, while yesterday's EMA carries 80%. See that? Recent prices really do have priority. You don't need to calculate this manually. Trading platforms like SuperX or TradingView will do it automatically. All you need to understand is that recent prices have more weight.
The core characteristics of EMA: responsive, smooth, and accurate signals. Because of this heavier weighting on recent prices, EMA has 3 key advantages you should definitely remember. First advantage, it stays closer to price action. With the same parameter, like 9, EMA will be closer to the candlesticks than SMA and won't lag as much. Second advantage, it's smoother. It filters out a lot of noise and avoids giving too many false signals. Third advantage, it's more aggressive with signals. Trend reversals and entry/exit signals appear earlier than with SMA, which is extremely important for short-term traders. Let me give you a real example. With the same 9-period setting, when the price pulls back, the EMA 9 catches the price immediately, while the SMA 9 is still lagging below. That's the sensitivity of EMA. For those who like to wait for pullbacks to enter, using EMA can help you capture more opportunities. Now, the key part. 4 practical ways to use EMA that you can apply immediately. The first point, identify the trend. Use a combination of short-term and long-term EMAs to determine direction. The simplest setup, a short-term EMA such as 17-period, plus a long-term EMA such as 21-period. When the short-term EMA crosses above the long-term EMA, for example, 17 crossing above 21, this is called a golden cross, which signals that an uptrend is likely starting, and the price will most likely continue to rise. Show chart example. When the short-term EMA crosses below the long-term EMA, for example, 17 crossing below 21, this is called a death cross, which signals that a downtrend may begin. Time to avoid risk. Show chart example. Remember, trend is the core of trading. First determine the direction, then look for entry and exit points. Your win rate will double. The second point, find entry and exit signals. Buy on a golden cross, sell on a death cross, but combine it with price action for better accuracy. Just looking at crosses isn't enough. You need to combine them with price movement. Buy signal. The price is rising. The short-term EMA crosses above the long-term EMA, and the price is not far from the moving averages. Entering here means smaller stop loss and larger profit potential. Sell signal. The price is falling. The short-term EMA crosses below the long-term EMA, or the price breaks below the EMA and fails to bounce back. Exit decisively. No hesitation. Here's a counterexample. If the price has already surged significantly, and then a golden cross appears, entering at that point can be risky. You might be chasing the top. EMA is powerful, but it shouldn't be used blindly. The third point, identify support and resistance. EMA lines act as a dynamic defense line. EMA is not just a trend line. It can also serve as support and resistance. In an uptrend, when the price pulls back, it often finds support near the short-term EMA, like the 17 period, which can be a good opportunity to buy the dip. In a downtrend, when the price rebounds, it often meets resistance near the short-term EMA, like the 17 period, which can be a good opportunity to sell high. You can check the assets you follow and see if the price often gets stuck around the EMA. That's market consensus. Use it well, and you'll avoid a lot of unnecessary mistakes. The fourth point, trailing stop. Use EMA to protect your profits and avoid the roller coaster. Many people make money and then lose it all back simply because they don't use stop loss properly. Using EMA for trailing stops is actually very simple. Holding a long position, place your stop loss slightly below the short-term EMA, for example, just below the 17 EMA. If the price breaks below it, it signals a trend change. Exit automatically and protect your profits. Holding a short position, place your stop loss above the short-term EMA. Once the price breaks above it, close your position quickly to prevent further losses. The advantage of this method is that it's a dynamic stop loss. It follows the trend, allowing you to capture more profit, while also avoiding reversal risks in time. EMA is not a magic tool. Finally, it must be emphasized, no technical indicator is 100% accurate, and EMA is no exception. When using it, keep these 3 points in mind. First, don't use it alone. Combine it with volume, MACD, RSI, and other indicators to confirm signals more reliably. Second, consider the market environment. In sideways markets, EMA cross signals often fail frequently. Don't force trades. It's better to stay on the sidelines. Third, manage your risk. Every signal can be wrong, so always set a stop loss and never put all your capital into a single asset. All right, that's EMA in 10 minutes. To summarize, EMA is a weighted moving average, more responsive and more accurate. The core uses are using golden/death crosses to identify trends, using support and resistance to find entry points, and using trailing stops to protect profits.
If you found today's content helpful, don't forget to like and subscribe to my channel. Next time, we'll talk about one of the most classic indicators in the market, MACD.